Welcome to Trading Nation. I'm Eric Chemi. Today we're joined by longtime bull Art Hogan. He's Chief Market Strategist at B. Riley FBR. Thanks for joining us here on Trading Nation.
Eric, thanks so much for having me.
So let's get right into it with the markets very volatile over the last, just call it several weeks here, and we're ending Q1. What does the rest of the year look like for you?
Well, it's interesting. So this is a year where a lack of volatility is being replaced by a great deal of volatility. By that I mean 2017 was abnormally calm. We had 8 days that had 1% moves. So far this year we've had 17, and counting today we'll probably have 18 1% moves. The average is about 53. We're on target to do about 95. So volatility is the new normal, and it's being driven really not by fundamentals, because they're very much intact, but being driven by a fear of policy mistakes. And those policy mistakes sort of coalesce around either a monetary policy mistake, being too aggressive there, or trade policy mistakes. And that's the latest variation of what's causing volatility here.
Well, it's funny because after the election, the consensus was, oh, 2017 is going to be extremely volatile, drop 25%, recession, all the people that were really concerned about a Trump administration doing, call it crazy things to the economy. And then, like you said, we saw the least volatile year we could have ever possibly imagined. And then everyone at the end of last year said, oh, well, the low volatility and the continued rises will just go right into 2018. And then the exact opposite happened. So it's getting really hard to predict what's going on here, right? I mean, how do you make sense of all this?
Yeah, it certainly is. If you look at 2017, we sort of had that view that we're going to have pro-growth, pro-business policy. We're going to get rid of Obamacare. We're going to have tax reform and infrastructure spend. And unfortunately, the timing of that didn't play out. So we didn't get repeal and replace. But then we pivoted immediately to tax reform. That was accomplished very quickly. And so we had that sort of end-of-year rally, really with a lot of the action happening sort of in the August to February peak. So I think the real run that we saw was that August to February peak of this year. Now, you know, we're still in that afterglow of what's positive about tax reform, and that certainly has worked its way into earnings estimates for the S&P 500. But what's different now is we're pivoting from taxes to trade, and that pivot is dangerous, and it's certainly, you know, one where we're going to have to be very delicate in the balance. So what's happening was an announcement of tariffs certainly caused some agita in the markets, and then they were watered down a bit a week later. But the concept of tariffs, whether they're on steel and aluminum or all sorts of products coming from China, comes with it a significant risk that we have retaliation.
Speaking of trade war and what's happening with policy there, we've got the news that Larry Kudlow will be joining the White House. He's not a trade war guy. How do you think his placement in the White House affects the markets? Can one person have that much of a difference?
Well, I couldn't be any more happy about the selection process here. I've known Larry for a couple of decades now. We've done shows together and had dinner together, and we have conversations all the time. I think one of the things he brings to the table here, and he agrees with the Trump administration very much on deregulation, very much on taxes, where they are going to disagree and have the most confrontational conversations is around trade. I think that's good. I think it's very good that there's another globalist and free markets person in the room while the discussions are being had. I think he's going to be a great sounding board. I think he's going to help balance things off, and certainly going to be a person in the room that we'd like to have as far as markets go. So I think he's got years, decades of experience with this. He was in the Reagan administration. He worked at the OMB. He's a very thoughtful man, and he certainly believes that free market capitalism is the best path to prosperity.
But it's interesting because he's replacing somebody who had a similar profile, at least in that sense. He's replacing a person who did not want a trade war, did not want to see these tariffs put into place, and yet we still got that result. So it makes me wonder if, in terms of you took one out, you put another one in, the balance of power among people in the White House who wanted these policies and the people who don't actually hasn't changed, and we know how that's gotten us so far. So what are your thoughts on that?
Well, that's a great question. So I think the good news is that we haven't elevated a nationalist. Peter Navarro's not taking this role over. So there is going to be both sides of the table having conversations about the best way to move forward. I think the president is open to that dialogue. As a matter of fact, he's come out and said he likes to hear that dialogue and hear both sides of the story. We also have to remember, you know, there is a school of thought and a cohort of people that believe the threat of tariffs being pulled back and being used as a negotiation tactic is probably where we're headed, both in steel and aluminum, and certainly in some of these larger confrontations that we're about to embark on with China. So if, in fact, we're using tough language in the upfront to use this as a negotiating tool, that's okay, as long as the end result is something that's a little more flexible and a little more business-friendly. The problem is that's a very tough needle to thread, and if you start off talking tough and there's retaliation, it's hard to unwind that. So I'm very glad that Larry's going to have a seat at the table and help modulate that conversation.
Do you think that placement prevents a growing trade war, a future trade war? Do you think it just sort of ends here where it's been the last few days? What do you think develops going forward?
I think what develops going forward, and Larry's been very outspoken on this, is that you have to look at not just capital goods and where your trade deficits come from. You have to look at the entire balance of trade. So, for example, when the steel tariffs were put in place, when we talked about having a budget deficit with Canada, it's not at all true. When you wrap together everything, the services they get from us, not just the goods that they get from us, we run a surplus with Canada. So I think having somebody in the room that can help describe that process better, maybe moving away from this budget deficit mantra that the administration seems to be so bent on, will be very helpful. So I think in the process, you're going to have somebody in the room, in Larry, that actually has the ability to make a very strong argument about how we should really be framing our policy and hopefully balancing off some of the nationalist rhetoric that's in Trump's ears all the time.
I'm reading here, and correct me if I'm wrong, that you still have a year-end target 3,000 on the S&P 500. Is that right? And
yeah.
What changes that view for you? Is it primarily trade war risk? Is it individual companies like Boeing suffering and maybe just bringing an average down along with it? How do you get to that number, and what gets you to pull away from it?
Well, that's a great question. I think the risk there is not fundamental. So the fundamentals behind that estimate certainly come in. You know, we've seen where the earnings estimates for the S&P 500 have moved from, December to today. Coming into today, we went from, in the middle of December, we're at about 146. For 2019, we're about 158 now. You put a market multiple on that gets you pretty close to 3,000. What would change that is a mistake, a policy mistake, a trade war or retaliation for tariffs, such that economic activity slows down and therefore earnings decline. So anything that's going to put a dent in the economy, whether it's the domestic economy, the global economy, and trade wars will do that, or something that's going to impinge on, because of retaliation, the earnings capability of the S&P 500. That's the risk here. So that target is based on fundamentals as they stand today. If we make a significant policy mistake, whether it's too aggressive a monetary policy or just a not well thought out trade policy, I think that puts at risk both the economy and the earnings capability for the S&P.
Art, this is fantastic. Thanks for coming on today. Really appreciate it.
All right. Thank you very much.
That was Art Hogan of B. Riley FBR. Thank him for joining us today. And thank you for watching Trading Nation. I'm Eric Chemi. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.